Well, I think that's right. I think that the sins that existed in the banking system, sins that were built up over the prior decade, haven't been completely dealt with. You know, David, at its root, banking is a pretty simple and a very good business. It's basically blocking and tackling, paying attention to the fundamentals, sticking within your circle of competence, coming to work every day and being sane. The business got so easy during a period of declining interest rates and a low cost of capital, where you could refinance out of your mistakes, that bankers quit the sanity part of banking. They engaged in what is called a time spread, which is to say they took on deposit liabilities that were very short term, overnight often, with variable interest rates, and they took on assets that were long term at fixed rates. When the interest rate rose, their cost of capital rose, while their return on capital employed fell, in some cases to negative levels. If you do that with a 6% or 7% equity slice, if you are dumb enough to take on a time spread, you deserve to go broke. Remember, David, past his prologue, this took down an industry in the United States some years ago called the savings and loan business. It was a fairly big business. And any banker today that didn't learn the lessons inherent in the 1990s with the savings and loan business deserves to go broke.
This
Absolutely are going to see more bank failures. The FDIC has to manage this crisis, both because of its own resources and because they don't want to see a crisis in confidence. But the truth is that the Fed brought this this problem on itself, in the sense that there are in place rules that allow banks that have long-term loans on the books, where they say that they are, quote, going to hold them to maturity. They don't need to mark them to market. All they have to do is make an election, whether true or false, that they're going to hold these assets to securities. In other words, what the banking regulators are allowing the banks to do is to perpetrate fraud. And the banks are only too happy to oblige. So yes, we are absolutely going to see more bank failures unless there is a fairly precipitous decline in the interest rate, which would skate those banks back onside. I don't think that the Federal Reserve wants to lower the interest rate, because the Federal Reserve is still concerned about inflation. So they're in effect stuck between a rock and a hard place. If interest rates stay high, the funding costs for the banks stay high, while the portfolio values of loans they made during periods of low interest rates fall, which is to say their liabilities overwhelm their assets. It's a very difficult conundrum for the Fed.
In a recent interview, renowned investor Rick Rule delivered a stark warning about the US banking sector, predicting a wave of failures on the horizon. Citing past sins unaddressed and risky practices, Rule highlights the precarious situation banks find themselves in, with liabilities outweighing assets for some. He emphasizes the importance of maintaining quality in banking practices, singling out community banks with solid asset-liability balance as examples. With hundreds of bank failures looming, Rule's insights underscore the need for caution in navigating the financial landscape.
I think reality is one problem. Despite the fact that the banks don't need to write off the losses, the banks do need to publish the amount by which their loan books are underwater. And so you have independent rating agencies, including Fitch, that will show you that the aggregate pro forma loan losses on some banks' books exceeds their equity. In other words, it's apparent to the market that these banks are zombies. The other thing that happens is that, to the extent that your cost of capital exceeds your return on capital employed, you don't have the money to make new loans, which is to say your failure, or at least you're being tripled, becomes a self-fulfilling prophecy. And we're seeing that across American banking. What we're seeing really among banking investors, community bank investors in particular, and also sophisticated depositors and sophisticated borrowers, is a return to quality. You're seeing very high quality community banks. things like Farmers and Merchants Bank of Long Beach, First National Bank of Alaska, banks that have always balanced their assets and liabilities, have always maintained good equity slices, and have never engaged in these crazy time spreads, do very well. You are seeing other banks that were too aggressive paying the penalty for being too aggressive.
Continuing his analysis, Rick Rule delves deeper into the intricate web of banking practices and political dynamics. He suggests that political motivations may influence regulatory actions, potentially impacting the fate of smaller banks. Rule highlights the looming crisis in commercial real estate, foreseeing potential strains on bank balance sheets regardless of size. He emphasizes the importance of adequate capitalization and prudent banking practices, advocating for simplicity and customer-focused services.
I suspect that the politicians view any act which even temporarily scares voters or constrains the flow of capital is a bad thing. My cynical belief is that probably some of these small bank shareholders, officers, and directors are important local campaign contributors, and that might have something to do with the willingness of people in Congress to force the banking regulators to make the banks much more forthcoming. I'd like to address the second thing you said, which is something that I didn't mention, but that is the difficulties that seem to be emerging around commercial real estate, in particular the office market. I was not too long ago in Manhattan, and I know that anecdote is not the same as statistic, but I was in a sort of a B grade office building, Midtown, and that office building was 12% occupied. There is no way that that building meets its operating expenses.
This is recently, Rick? Recently?
Yeah,
Okay.
3 months ago.
Okay.
Never mind services its debt. And I do believe that in some markets, and I'm not an expert on commercial real estate, but I do believe in some markets that the other shoe is yet to fall with regards to commercial real estate, and that's impact on some banks' balance sheet. My suspicion is that the carnage there won't be restricted to banks with a sub $10 billion market capitalization. It may be that the mega banks are too big to bail out. But the truth is that I think that some of the big banks will, for a time, become less competitive too, as a consequence of strains on their own balance sheet. I think that this will be felt throughout the banking system. By the way, much to the benefit of sanity-based banks. From a depositor's point of view, most people will be taken care of. It's worthy to note, by the way, in the bankruptcy of Silicon Valley Bank, that the politicians decided that even the jumbo depositors, the politically connected, the important depositors of Silicon Valley Bank should be covered. So while federal deposit insurance only covers deposits up to $250,000, when it's bad politics to allow depositors to be punished for being non-judicious or stupid, the government bails out those depositors too. Well, I think what you have to concern yourself with is confidence. Economies in the near term and currencies rely on confidence. To the extent that we have a new rash of bank failures and confidence in banking, in the economy, in equity markets, in the American political system begins to get challenged, then what I think you see is the typical political response, which would be to say quantitative easing and fiscal measures to what really should be a regulatory issue. I think that banks should be adequately capitalized, first of all.
Yeah.
The powers that be suggest that an equity slice of 7% is adequate to run a lending portfolio. At age 71, I much prefer 10 to 7. I think having a larger equity slice is better business. I think, too, the banking business has been its own worst enemy in the sense that the banking industry continues to contrive new deposit products whose principal aim seems to be to trick customers as opposed to service those customers. In the banks that I've been involved with, we generally have one deposit product, a high yield money market account that you can write checks against and still get paid money for your money on deposits. We, and by extension, the whole banking industry doesn't need 15 deposit products. You need one money market deposit, and you need a range of CD deposits that suit the customer's need. The purpose of any business is to suit its customer, and the banks seem to have forgotten that. On the lending side, I like banks that lend only to industries that they understand. Some of these financial supermarkets attempt to lend in 1,000 industries. How can they possibly understand 1,000 industries? In banks that I have been associated with and banks that I've been an investor in, banks that have been successful, they have known 3 or 4 or 5 things extremely well. They have competed very vigorously in the markets that they understand, and they haven't gone into markets that they don't understand. Those banks are thriving today.
Today's discussion with Rick Rule sheds light on the intricate challenges facing the banking sector, from risky practices to political pressures. Rule emphasizes the importance of fundamental banking principles and adequate capitalization, while cautioning against overly complex deposit products and lending in unfamiliar industries. As we navigate uncertain times, Rule's insights serve as a compass for prudent banking practices. Thank you for joining us. Don't forget to subscribe to our channel for more insightful discussions like this video and share your thoughts in the comments below.